Are you noticing rising prices, job uncertainties, or a general sense of economic unease? These could be indicators of an impending recession. Understanding what a recession is, recognizing its signs, and knowing how to prepare can make a significant difference in navigating challenging economic times. In this video, we'll delve into the definition of a recession, explore its common causes, identify warning signs, and provide actionable steps you can take to safeguard your financial well-being. Whether you're an investor, a business owner, or someone keen on staying informed, this guide is tailored for you. Before we dive in, make sure to like, share, and subscribe to our channel for more informative content. Understanding what a recession is. A recession is commonly understood as a significant decline in economic activity that persists for an extended period, typically visible in various economic indicators. The National Bureau of Economic Research, NBER, defines a recession as a period where the economy experiences a substantial decline spread across the economy, lasting more than a few months. This downturn is often reflected in real GDP, real income, employment, industrial production, and retail sales. While 2 consecutive quarters of negative GDP growth are frequently used as a rule of thumb, the NBER's definition encompasses a broader range of economic indicators. Understanding this helps in recognizing the multifaceted nature of economic downturns and the various factors that contribute to them. Key indicators signaling a recession. Recognizing the early signs of a recession can be crucial for timely preparation. One primary indicator is a significant drop in consumer confidence, which can lead to reduced spending and investment. For instance, the Conference Board's Expectations Index recently fell by 12.5 points to 54.4, well below the recession warning threshold of 80, marking the 5th consecutive month of decline in consumer sentiment. Additionally, rising unemployment rates, declining industrial production, and reduced retail sales are classic signs. An inverted yield curve, where short-term interest rates exceed long-term rates, has historically been a reliable predictor of recessions. Monitoring these indicators can provide valuable insights into the health of the economy and potential downturns. Common causes of recessions. Recessions can be triggered by various factors, often interlinked. One common cause is a sudden economic shock, such as a sharp increase in oil prices, which can lead to higher production costs and reduced consumer spending. Financial crises, like the 2008 housing market collapse, can also precipitate a recession by disrupting credit markets and reducing consumer wealth. High inflation or deflation can erode purchasing power and savings, leading to decreased spending. Additionally, poor fiscal policies, such as excessive government debt or abrupt changes in taxation, can destabilize the economy. Understanding these causes helps in identifying potential risks and implementing measures to mitigate their impact. The role of consumer confidence. Consumer confidence is like the heartbeat of the economy. When it's strong, people spend more, fueling growth and keeping businesses thriving. But when optimism fades, wallets close, sales drop, and companies start tightening their belts, which can mean layoffs and slower hiring. Right now, confidence in the U.S. has taken a serious hit, dropping to its lowest level since 2011. What's behind the unease? Rising inflation, job insecurity, and confusing tariff policies have left many unsure about their financial future. This dip in trust doesn't just affect shopping habits, it sends ripples through the entire economy, hinting that a recession might be on the horizon. That's why keeping an eye on how confident people feel about money matters. It's one of the clearest signs of what's coming next. Impact on employment and wages. During a recession, businesses often face declining revenues, prompting cost-cutting measures, including layoffs and hiring freezes. This leads to rising unemployment rates and increased competition for available jobs. Wage growth may stagnate or even decline as companies attempt to manage expenses. The resulting decrease in household income further reduces consumer spending, creating a feedback loop that can deepen the recession. For instance, during the last global recession, unemployment in the U.S. hit 9.5%, significantly impacting consumer spending and overall economic activity. Understanding this dynamic underscores the importance of employment trends as both a cause and effect of economic downturns. Effects on businesses and industries. Recessions affect various industries differently. Sectors like manufacturing, construction, and retail often experience significant downturns due to reduced consumer demand. For example, U.S. manufacturers have reported a sharp drop in incoming orders and foresee significant sales declines, particularly in the computer, electronics, and transportation sectors. Small businesses may struggle with decreased sales and tighter credit conditions, leading to closures or downsizing. However, some industries, such as utilities and healthcare, may remain relatively stable due to consistent demand. Understanding these sector-specific impacts can guide investment and career decisions during economic downturns. Government and central bank responses. In response to recessions, governments and central banks implement various measures to stimulate the economy. Monetary policies, such as lowering interest rates, aim to encourage borrowing and investment. Fiscal policies, including increased government spending and tax cuts, are designed to boost demand. For instance, during economic downturns, central banks may reduce interest rates to make loans more affordable, encouraging businesses to invest and consumers to spend. Additionally, government stimulus packages can provide direct financial support to individuals and businesses, helping to stabilize the economy. These interventions are crucial in mitigating the severity and duration of recessions. Personal financial strategies during a recession. Navigating a recession requires proactive financial management. Key strategies include building an emergency fund to cover essential expenses, reducing discretionary spending, and avoiding new debt. Prioritizing debt repayment, especially high-interest obligations, can alleviate financial stress. It's also advisable to review and adjust budgets, focusing on necessities and identifying areas for cost savings. Diversifying income sources, such as pursuing side gigs or freelance work, can provide additional financial security. Moreover, maintaining open communication with creditors can lead to flexible repayment options during challenging times. Implementing these strategies can enhance financial resilience during economic downturns. Investment considerations in a recession. Recessions often lead to market volatility, impacting investment portfolios. Investors may consider shifting towards more conservative assets, such as bonds or dividend-paying stocks, which tend to be less volatile. Diversification across various asset classes can mitigate risks associated with specific sectors. It's essential to avoid panic selling during market downturns, as this can lock in losses and hinder long-term financial goals. Instead, maintaining a long-term perspective and adhering to a well-thought-out investment strategy can help navigate turbulent markets. Consulting with financial advisors can provide personalized guidance tailored to individual risk tolerance and financial objectives. Preparing for future economic downturns. While it's impossible to predict the exact timing of future recessions, being prepared can mitigate their impact. Regularly reviewing and adjusting financial plans, maintaining a diversified investment portfolio, and staying informed about economic indicators are proactive steps. Building a robust emergency fund, reducing unnecessary expenses, and avoiding excessive debt enhance financial stability. Continuous skill development and career advancement can provide job security and open new opportunities. Engaging with financial professionals for personalized advice ensures that strategies align with individual goals and risk tolerance. By adopting these measures, individuals can enhance their resilience against future economic challenges. Understanding the dynamics of a recession, its causes, indicators, and impacts, empowers you to make informed decisions and safeguard your financial well-being. By staying vigilant, adopting prudent financial practices, and seeking professional guidance when necessary, you can navigate economic downturns with confidence. Remember, while recessions are challenging, they are also temporary phases in the economic cycle. Preparation and adaptability are key to weathering these periods successfully. If you found this video helpful and informative, please hit the like button, subscribe to our channel, and share your thoughts in the comment section below. Thank you.